So where is that 110 billion all total going? And with today, I guess 115 billion. Joe Grano, former UBS Paine Webber chairman, and all so much more. I was shocked, Joe, maybe naively so, how little money goes to consumer debtor relief. A fraction.
Well, unfortunately, 5.1 billion is not going to influence it much at all, given the magnitude of what happened.
Indeed, with 110 billion before it.
And what I find interesting, though, is that the young lady talking about the government, no one's holding the government accountable for being the catalyst of the problem in the first place.
That's what I was saying earlier in the
1999, when Clinton forced Fannie Mae, Ginnie Mac, et cetera, to lower credit standards. No one holds them accountable for it.
And what we did in the process, and this always sounds cruel when you say it, as if I'm an apologist for banks, I'm not. But if you give them some wiggle room, they'll wiggle. But my point was they changed owning a home into a birthright, not a goal. And all of a sudden that made that anyone with a pulse could get a loan.
Well, I'm
I'm worried about that.
I'm not absolving Wall Street because they leveraged the hell out of it.
Absolutely, and I always posit that too. But give them a little bit of rope, they'll be happy to hang you and them. But I just think it went beyond the pale.
Well, the rating agencies that put AAA on those securities that ended up getting flipped, dipped, sliced and diced, which really weren't AAA, and the derivatives divorced themselves when there's no liquidity, and that's what happened.
All right, now, but investors were duped. But I do find that in the proceeds and the rewards for duping them, Fannie Mae and Freddie Mac are getting billions, 39 billion going to Fannie and Freddie from the Treasury. And they were a large reason why we had the problem we did. So not only are they being ignored in the punishment, they're being rewarded with the punishment.
They constitute the equivalent of a moral obligation from the government. They've been put in that position to be the conduit, FHA, in terms of guaranteeing loans, 97%. So I think that they are embedded in the process. You're right, we could probably step back and say, what do we have to do to get, call it, not only better regulation, but better standards?
All right, now, the banks have had a tough quarter. That is, their stocks had a tough quarter. Goldman's been resilient in the face of this big settlement. It was largely expected. But I must say something that in the face of a $5 billion plus settlement, the stock merrily moves on.
Well, they were adequately reserved. Let's start there.
Absolutely.
They had the adequate reserve.
So the bigger issue for these guys is whether they're set for the next.
Well, all of the banks and all of the financials are under pressure because of net interest income. When interest rates are so low, the spreads shrink. But also the result of regulation.
And the fear something could happen.
Dodd-Frank is 19,000 pages. And what's happened here is that the smaller banks, community banks, middle banks, who were 41% of all bank assets, are down to 22. They're not lending money to sole proprietors, and that's the problem in the economy today.
So for folks like you, and maybe a big difference there, for average folks who are looking at getting loans and still finding it difficult for their bank to cough up, it's a little better than it was. But what reason would the banks have to improve that business?
Well, I think if they weren't taxed with the regulation that they are and taxed with reserves, that the whole issue of too big to fail, which was the catalyst for Dodd-Frank, is the wrong approach. It's not the size of the institution. It's the size of a position that can create a systemic risk. If the Fed looked at positions, concentrated positions, they would ask the right questions and they'd put in the right safety nets. It's not about the size of the institution. It could be one individual, like the whale in London, cost billions of dollars. So the issue is, are you leveraged to the point where that concentrated position can cause a systemic risk? They've cascaded that down.
Their size doesn't matter as much as what's involved.
Leverage is the enemy.
Yeah. You're very cheap, right? You don't like debt.
No, I don't like debt at all.
Joseph, thank you very, very much. Joe Grano, Wall Street legend, and an honorable one of that. They have them now and then. There are a few of them.